I think this is a great they're presenting great opportunities at this point to go long the market, both in the S&P and internationally in emerging markets. Valuations are very attractive at this point, both in the U.S. and in the emerging space. I think if we get a turnaround on the two fronts that took markets down this year, which is anticipations on Fed hikes, as well as trade tensions with China, which I was on with you guys actually before the G20, and I remember saying there's a very good chance that we get some de-escalation of trade tensions. And I think, in fact, we are getting that.
So if at the beginning of 2018, if by the end of 2019 we're 50 points lower than you thought would be at the beginning of 2018, those are two disappointing years, aren't they?
Look, I think, again, the market is reacting to something that is a fear, not reality. A deceleration in economic growth from 3% to 2.6% or 2.8%, which is my call for next year, is still above potential growth. Potential growth in the U.S. is 2.2%. And I think the market is really exaggerated with regard to the market collapse precipitating a recession. One thing does not necessarily mean the next. I think recession is too much discounted in the market pricing at this point. We're not going to get it next year.
So at this point, you buy the S&P today?
I would be buying the S&P.
Today.
I would be buying the S&P. I would be buying certain sectors, namely financials, industrials, some energy names, as well as the emerging markets. I think that those have been severely battered, Joe, over the past year.
So if you buy, Monica, will you wish you had waited a month to buy even cheaper, or you buy here?
I think it's really hard to pick the bottom, of course.
Yeah.
And to Kathryn's point, all these questions around sentiment, that's what's going on now, right? People are very nervous. What's going to happen in China? What's going to happen with the shutdown? And that's being priced into the market.
You think the shutdown is a big concern for most people? Don't markets go up during most shutdowns?
That's a good point. But I think the question is we have uncertainty picking up while liquidity is going down, and that's a perfect storm for what we're seeing right now, which are these big intraday swings that are unsettling people, and I think that impacts sentiment. But fundamentals, I agree with Kathryn, remain very strong.
So do you have price targets on the S&P, or do you?
Yeah, I mean, I think the challenge we're facing, again, we were looking for flat plus or minus 5% next year, but after this pullback, I think if you believe valuations stay where they are, or maybe even increase a little bit, and we're about 2 turns below historical averages, there's a good case to be made for up mid to high single digits.
Should valuations be where they are right now? I mean, in terms of earnings growth for next year, have we seen all the revisions downward on earnings?
Valuations are telling you earnings should be declining, where that's not what we see. We do see growth moderating, and I think that's normal for where we are in the cycle, especially given we don't have the impact of tax cuts next year.
Kathryn, you mentioned that Fed rate hikes is one of the big fears for the market this year that surprised it. How many would be fine for equities to perform as your target suggests?
Well, certainly the dollar movement over the course of 2018 indicated that the market was pricing in more hikes in 2019, which are unlikely to manifest. I think we are max going to get 1 hike next year. I doubt we get a rate cut, and I agree with a prior conversation that if we were to get it, it would be a negative indication of a more aggressive deceleration in terms of economic growth than I would have foreseen. So I think we get 1, and the market is completely discounting that. So if in January we do get a de-escalation of trade tensions, if we do get earnings reports from the fourth quarter coming in pretty good, and a more conciliatory Fed, and I do think that the stars are aligned, incentives are aligned for both Trump and Xi to come with some resolution with regard to trade tensions, then we do get market upside. So as Monica said, and I agree with that, this is sentiment driven. What we need is some impetus, some spark to move the trajectory, move the momentum off of this bearish, bad news is bad news, good news is bad news scenario.
Monica, I'm wondering, you said liquidity is declining at the same time that, of course, you have this sense of uncertainty increasing. With the turn of the year, is that going to change? Because, I'm looking at the tactical stuff. And yesterday, it checks off a lot of boxes, right? 90% of the volume's up. It was actually overwhelmingly positive breath. The market kind of made a stand at that negative 20% mark, whatever. On the other hand, biggest rallies happen in bear markets. Can you really trust a move in the last week of the year?
Yeah, I think the challenge is we can all sit here and say things look cheap, valuations look attractive for the growth we're expecting, but cheap things will stay cheap unless there's a reason to become more positive. And so until we get some resolution, something on trade, and more than just a tweet or a comment, we need real movement forward and a couple granular ideas people can get behind, I think we'd probably stay in this range, but that could give us the breakout if we get resolution there. And of course, earnings, right? If earnings come in okay, and we don't need a great number, just okay, and no big declines for 19, that should be the catalyst.
Sounds like there's no real pressing reason to buy then. If we should be waiting for a catalyst and we're going to remain range bound, I mean, if you're inclined to buy, maybe do part of a position in a stock you want to own or an index you want to be owned.
For these catalysts that are coming up. And there's a lot of ways to do that. There's a lot of volatility. It could be maybe not long outright, using derivatives, something like that.
Kathryn, you said financials. You're attracted to any names in particular, and what's the catalyst for them?
I would say the sector, and certainly one of the catalysts, of course, is the correlation that financials have with 10-year treasuries, right? So if the treasury is at 270, I see it going above 3 easily next year, with inflation picking up, economic growth, a Fed that hikes, at least once. I think probably maximum once, honestly. But I think financials do very well in lower regulation. It's a cyclical. Economic growth stays strong and steady. Valuations are, again, of course, very attractive. But I think that's where you want to be positioned. And in industrials, if we do get, as I'm expecting in January or early next year, some de-escalation of trade tensions with China, then we do get a pickup in industrials, which have been pretty battered.